In the shadow of empires built on coin, cities rise not by walls or armies, but by the quiet, unstoppable power of money. Along the banks of the Thames, where fishing boats once carried salted herring and bales of wool, a transformation began that would take centuries to complete and reshape the entire world in the process. This was not a story written in the language of conquest. No general planned it. No king decreed it. It grew in the back rooms of coffee houses, in the ledgers of merchants willing to risk everything, in the ink of bond certificates that turned government debt into opportunity. London did not seize its place at the center of global finance. It earned it through crisis and innovation, through war and resilience, through a financial architecture so powerful that it would one day govern the fates of nations on every continent. This is the story of how a trading port became the financial capital of the world, and how money itself became the most powerful force in human history. If you want to understand how the modern financial world was built, stay with us. The answer begins here, on the banks of the Thames, 6 centuries ago. The story begins not with banks or bonds, but with ambition. In the late 16th and early 17th centuries, London was a growing but unremarkable European port, wealthier than most English cities, but still a junior rival to the great financial centers of Antwerp and Amsterdam. Its economy ran on wool exports and coastal trade. Its merchants were prosperous but cautious. What changed everything was a single institutional innovation that London's merchants were the first to deploy at scale: the Joint Stock Company. In 1553, the Muscovy Company became the first chartered joint stock venture in English history, allowing multiple investors to pool capital for a single commercial expedition and share both the risk and the reward. The model proved so effective that it was replicated and refined throughout the century. Then, on December 31st, 1600, Queen Elizabeth I granted a royal charter to 218 merchants and adventurers, creating the East India Company. Their combined capital of £68,373, modest by continental standards, was transformed by the joint stock structure into an instrument of extraordinary reach. Ships sailed to Java, Sumatra, and the Indian subcontinent, returning with pepper, spices, and textiles that sold in London for hundreds of % more than their purchase price. The returns were staggering. Early East India Company voyages delivered profits of between 100 and 300%. Wealth poured into London at a rate the city had never seen. Along the Thames, docks expanded and warehouses filled. In the coffee houses of Exchange Alley, particularly Jonathan's and Garraway's, merchants gathered not just to trade goods, but to trade information, speculate on future voyages, and negotiate the financial contracts that made it all possible. These coffee houses were not merely social venues. They were the first informal financial markets in English history, the direct ancestors of the London Stock Exchange. Money was no longer something you earned by selling a product. It was something you deployed, risked, and multiplied. The merchant class of London had discovered leverage, and they would never look back. By the 1690s, London faced a financial crisis that would force it to reinvent itself. England had been drawn into the 9 Years' War against Louis XIV's France, a conflict of unprecedented scale and cost. The government's finances were in ruins. Traditional methods of royal borrowing had been exhausted, and discredited. King William III needed money desperately, and he needed it in a form that could sustain a prolonged European war. The solution came from a Scottish entrepreneur named William Paterson, who proposed a revolutionary idea. A syndicate of private investors would lend the government £1.2 million at 8% interest. In return, those investors would be incorporated as the Bank of England, granted the right to issue banknotes backed by the government's promise to repay and to act as the state's financial agent. The Bank of England opened its doors on July 27, 1694. Its founding was not simply the creation of a new institution. It was the invention of a new financial relationship between private capital and the state, one built on credibility, trust, and institutional continuity, rather than the personal whims of monarchs. For the first time, government debt was not a burden to be hidden, but a structured, tradable instrument. Investors could purchase government bonds, known as consols, earn a reliable interest rate, and sell those bonds to other investors at any time through the emerging secondary market. The national debt became a financial asset. Credit became a tool of power. This single innovation gave Britain a decisive structural advantage over its rivals. France, governed by an absolute monarchy with no equivalent transparent debt market, was forced to borrow at far higher rates and with far less reliability. Britain could sustain wars, fund navies, and finance empire at a fraction of the borrowing cost of its competitors. In the century that followed, Britain would fight and win 4 major European wars, not primarily with superior armies, but with superior credit. London's coffee houses evolved in parallel. At Jonathan's Coffee House in Exchange Alley, traders began formally listing the prices of stocks and government bonds. In 1698, John Castaigne began publishing a twice-weekly price list called the Course of the Exchange, the direct precursor of the London Stock Exchange's price list. The machinery of modern financial markets was being assembled, one institution at a time. The 18th century was the century in which Britain's financial system became its most powerful imperial weapon. The numbers tell the story with brutal clarity. In the 7 Years' War of 1756 to 1763, a conflict fought simultaneously on 5 continents, Britain spent approximately £160 million. France, with a larger population and greater agricultural wealth, spent a comparable sum, but Britain financed its war primarily through bond markets at interest rates between 3 and 4%. France was forced to suspend payments on its debt twice during the conflict, each time destroying investor confidence and raising its future borrowing costs further. Britain won. France collapsed financially, and the pattern would repeat in every major conflict of the century. At the center of this financial war machine was the City of London, the specific square mile around the Bank of England that had become the most concentrated geography of financial power in the world. Within that single mile, you could find the Bank of England managing the national debt, Lloyd's of London, which had grown from Edward Lloyd's Coffeehouse into the world's preeminent marine insurance market, underwriting the risk of the global trade network, private banks including Barclays, Hawes, and Child & Co. financing merchant expeditions and government contracts, and the Royal Exchange, where commodity prices and currency rates were set for markets across Europe. The British East India Company extended this financial architecture overseas. By the mid-18th century, the company was not merely a trading enterprise. It was governing territories, collecting taxes, and fielding armies funded by shareholder capital raised on the London markets. The line between commerce and sovereignty had dissolved. And then came Nathan Rothschild. In 1815, following Napoleon's defeat at Waterloo, Rothschild's London banking house coordinated the financing of Allied war debts across Europe with a speed and sophistication that no single government could have achieved alone. The Rothschild network, stretching from London to Paris, Vienna, Frankfurt, and Naples, demonstrated something new, that private banking houses operating from the City of London could exercise financial leverage over sovereign states, not through armies, but through the control of coin. London had not merely financed an empire, it had become the empire's operating system. The rise of London's financial power was not a smooth ascent. It was marked by catastrophic failures that threatened to destroy everything that had been built. The South Sea Bubble of 1720 remains one of the most spectacular financial collapses in history. The South Sea Company had been granted a monopoly on British trade with South America in 1711. By 1720, its promoters, with the active connivance of government ministers, and the implicit endorsement of King George I himself, engineered a scheme to assume the entire national debt in exchange for inflated company shares. Share prices rose from £100 in January 1720 to over £1,000 by August. All of London was speculating, from dukes to domestic servants. When the bubble burst that autumn, the losses were catastrophic. Thousands were ruined. Several government ministers faced parliamentary investigation. The national mood turned violently against financial speculation. What happened next is what separated London from every other financial centre in Europe. Rather than retreating from finance, London reformed it. The Bubble Act of 1720 tightened regulations on joint stock companies. The Bank of England's role as a stabilising anchor was reinforced. Parliamentary oversight of financial markets intensified. Crucially, the core institutions, the Bank of England, the bond markets, Lloyd's of London, survived intact. The system had been stress-tested and had held. Across the Channel, France experienced an even more catastrophic bubble in the same year. John Law's Mississippi Company collapsed with consequences far more severe than London's South Sea crisis, devastating French public finance for decades and permanently undermining French investor confidence in financial markets. Paris never recovered its ambition to challenge London as a global financial centre. London's 1720 crisis was painful, but it produced something more valuable than lost money. It produced institutional resilience. Every subsequent crisis, and there would be many, would be met by a system that had already survived its first catastrophic test. Each collapse refined the mechanisms of risk, regulation, and recovery. London was not just building a financial centre, it was building a financial immune system. By the mid-19th century, the outcome was beyond dispute. London was the financial capital of the world, not by declaration, but by the accumulated weight of institutional trust, market depth, and global reach that no other city could match. The Industrial Revolution accelerated the process. The mechanization of production created voracious demand for capital investment. Factories, railways, canals, and mines required financing on a scale that dwarfed anything that had come before. London's banks and bond markets rose to the challenge. Between 1830 and 1870, British investors financed railway construction, not just in Britain but in the United States, Argentina, India, and Australia. At its peak, Britain was exporting approximately 10% of its national income as overseas investment, an extraordinary figure that meant London's financial decisions were shaping the physical infrastructure of the entire industrializing world. The pound sterling, backed by the gold standard formally adopted in 1821, became the world's reserve currency. Contracts were denominated in sterling. International commodity prices, cotton, wheat, copper, sugar, were set in London. Bills of exchange drawn on London banks were the preferred instrument of global trade settlement. To operate in the international economy meant in practice operating through London. The City of London itself, that ancient square mile, had evolved into the most specialized and concentrated financial district in human history. Merchant banks like Barings and Rothschilds arranged sovereign loans for foreign governments. Discount houses managed the short-term money markets. The stock exchange listed securities from companies operating on every continent. Insurance syndicates at Lloyd's covered risks from the Arctic to the Pacific. In 1890, when the Argentine government defaulted and threatened to bring down Barings Bank, one of the most powerful merchant banks in the world, it was the Bank of England that organized a private rescue consortium to prevent a systemic collapse. No equivalent institution existed anywhere else in the world. London had not just a financial center, it had a financial central nervous system. By the close of the 19th century, the city that had begun with merchants trading wool along the Thames had become the nerve center of a global financial order. Money flowed through London the way blood flows through a heart, outward to every extremity of the world economy, and back again, sustaining everything it touched. And in the quiet turning of ledgers, in the invisible flow of credit across oceans and continents, London proved the truth that every age of finance eventually teaches, that the greatest power is never the sword, never the cannon. It is the ability to make others believe in your promise. Build that trust, sustain it through every crisis, and the world will bring its money to your door. If this journey through London's financial history has changed the way you see the world's economic order, share it, subscribe, and follow for more stories of how money shaped the civilization we live in. The next chapter of financial history is already being written.